welcome to segment 4 of the 2021 FCA Grain Outlook meeting. Matt, go ahead and share your screen if you would for the slides and take it away.
All right, I hope you guys can see part 4. I've titled that Inflation versus Bubble, and kind of think we're going to talk a lot about money flow and just how that's affected the market. All right, so let's start off with some, these aren't things I normally would put in an Outlook meeting, but we have to talk about it. This is too critical right now. This shows along the bottom the basically a listing of most of major commodities. And I know you kind of have to hurt your neck to look at it, but what this shows is a 1-year return on each of these commodities. These are the major commodities we're going to trade. 1-year returns. So basically last year, going through COVID, going through all of the, whatever it was, these are commodities. These aren't equities. These are things we actually have to consume. And lumber, all-time record. Canola, all-time record. Copper, 7-year highs. Soybeans, 5-year highs. Natural gas, maybe a little bit different thing going on in the natural gas market. But I mean, these are commodities we know and love. A lot of the ags are in the left third of that chart. What's on the right third? Things like the dollar. Well, the dollar being lower on the year is actually supportive to commodities. There's very little that's in the not performing well this year. Now, this chart on the inset is the CRB index, which is basically the Dow Jones of the commodity markets. Now, you can see we're definitely seeing signs that as we talk about commodities as a group, they are starting to move forward, move higher into, several multi-year highs. Now, 2008 is going to stand as the absolute peak of commodity market index values, as we had a lot going on, which we'll talk about more in the next few slides. But I wanted to just introduce the term. I think super cycle is something that we're hearing phrases of, and a super cycle is something that it's not a one thing. It's not a one commodity. When you have a corn market that has a drought, you have an immediate price reaction. That's doing one thing. Maybe crude oil's got $40 a barrel. Those two things are trading different supply and demands. They're trading their own things. In a super cycle, it's basically like everything's kind of going up at the same time. Everything's moving up. We've got this situation where all of these commodities are in the green, and it's happening in unison. Yes, there's fundamental stories in our grain markets with China being a top one, but realistically, in my opinion, this corn market is priced above where it would normally be with this fundamental outlook because of the kind of money flow we've seen come to all commodities right now. So that gives you the discussion of inflation. I think when you see, it doesn't matter what we think or what we think about inflation, we know that commodities in general are going higher. So we're seeing buying, we're seeing things take place. There's also this fear of a longer term situation with inflation, not even just with where we are today, but there's a lot of money supply. And I want these two charts are slightly outside of my comfort zone, but we want to look at them very closely because we've dumped an awful lot of money into our economy. And we're just seeing, this is even before a $1.3 trillion dump we just saw the last week. So the money, this is change in money supply. Can I use the word unprecedented one more time in this presentation? Unprecedented. Having said that, I know we've seen some changes in equities. We've seen some changes in a lot of things out there, commodity prices. But generally speaking, this capital that's in the economy is not being deployed. That gives everybody a little bit of concern. There's a lot of money. It's not going into the economy very fast. That leads us to believe that at some point, something's going to have to click and there will be some inflation that actually takes place. Right now, however, it's not there. And that's what I think is kind of interesting. A lot of this concern is that we're going to have inflation. So far, this is inflation so far, where we are this year. The Fed would target perfect inflation, ideal inflation, about 2%. That's a situation where you've got a healthy economy. That's ideal. We're running about a 1.5% right now. So we're not even at that level that they view is ideal, even though everybody thinks that there's almost no way where we don't see some level of it as these dollars start to chase assets and things start to inflate. The other thing that doesn't seem like inflation is GDP. Most peaks, most inflation cycles take place as global GDP is rising, and that's not taking place right now. A lot of that's COVID, but really the only place you're seeing real GDP growth right now is reportedly in China. So we're just not seeing that global growth in GDP. So it doesn't feel like we're seeing real inflation yet. But we are seeing a lot of that base layers taking place. So what I mean by that is we're seeing some of that money flow into commodities. And I wanted to go to this chart. Now this is you're gonna have to go with a little bit of a leap of faith on this with me. This is a little complicated, but I wanted to talk about this. So we've got basically a zero interest rate environment right now. Our interest rates are still one of the lowest we've ever seen, even though we think that they're going to skyrocket in the next few years. But the zero interest rate environment, we've got a lot of money in the marketplace. It's not going anywhere. Investors are looking for how do we make a return on a market that has zero interest rate. Commodities have some things that are attractive. One, they've got a story. People are worried about it. If they're worried about inflation, commodities are a natural hedge. I think there's people that are worried about supply chain distributions. Commodities could be an issue there as other nations talk about food security, especially China. There's a play there. But let's look at realistic money flow, and that's what this chart shows. All right, so I've got the forward curves of 6 different markets, and it really wouldn't matter. You could take lumber, you could take any of the commodities we talked about. Forward curve shows nearby futures here and deferred futures out here. In other words, this is where spot pricing, today's pricing is. This is where we're currently valuing the forward market, okay? All of these forward curves are what we would call inverted. Inverted meaning the current price is the highest price, the cheapest prices are the deferred price. Now the money crowd is looking at that and looking at it, and they're drooling because they're saying, I have a positive return on my yield when I move my position forward. So commodity markets are long crude as it goes up. Then when they need to get out of that long position, they reinvest that position down here. So that's a positive role for the investor of the commodity market. Because these markets are cheaper in the back market, that's where they're making money. That's something I've seen this. This was an article from Bloomberg. They sourced people like Goldman Sachs, Citibank. This is where they're seeing the biggest returns is in the backward markets, the inverted markets. They're putting their money in, markets rise. They then get to liquidate that and redeploy it cheaper. This is not common in commodity markets. Normally we see the grains are usually in the opposite. As you guys know from the growing side of things, the usually spot corn is cheaper than new crop corn. And that's usually the way it's going to be. This year it's different. And this year, a lot of that could be because of some of the money flow, putting those inverses in the market, but it is just they're making money on this roll. Commodities are an attractive asset for a lot of reasons, but this is actually working for them very well. So that's a main reason why I think we've seen a massive amount of money flow into commodities. I'm going to pause there for any questions. Okay. So we'll hit the money flow discussion a little bit again, but I do want to also talk about money flow on a year that it's not dear isn't the word, but near to my heart. That we need to look back at some of the situations we saw back in 2008. So up until the last 2 or 3 weeks, the current July futures chart has completely mimicked the 2008 chart. I mean, almost every single aspect of it. The peaks. I mean, this one makes me almost laugh at how that peak happened right there, and then the valley happened right there. I mean, just extremely similar years. Now, 2008 had other similarities. That was a year where we were talking about inflation. That was the first time in my career I remember a lot of people talking about a significant period of inflation. We had the backdrop of ethanol coming online at an aggressive pace. And we had a culmination as we started to have some weather issues back in June of 2008. But you can see both corn and beans have been very much mirroring that year. So let's look at that a little bit closer. I think there were 3 phases in that 2008 crop. The first phase was kind of, I think it's interesting to look like 2007 forward. You had a slight uptrend in the market, but you didn't have a real crazy situation. That's kind of what it was this year. You know, from about September, October, November, this was kind of what we were doing this year as well as back in 2007 and transitioning in 2008. Kind of a nice uptrend. And then all of a sudden December came, we had 15 consecutive days of higher closes and a much more erratic period. This is where we are kind of currently, is in phase 1 of that massive money flow. The massive money flow in corn really started to take place about DS1. And that's where we are right now. We're chopping around, very volatile, very high ranges every day, some down days, some up days, kind of flirting with some support and resistance. We got through the resistance that year in about April, May, and that created phase 2. And phase 2 was kind of a consolidation phase. You know, it was kind of that we saw another round of money. It wasn't a lot. Growers had sold almost all their old crop corn into that phase here. Sound familiar? You know, that's about where we are this year. A lot of sales took place in this period. This wasn't met with a ton of fund money. It wasn't met with a ton of farmers selling. It was just kind of a consolidation phase in yet a new range. Then we started to have the blow off, and the blow off was where it wasn't real fun. Crude oil was going to $140 a barrel. Corn started to see planting delays take place in eastern Iowa on the culmination of all this stuff, and all that stuff just triggered into this blow off. And the blow off went from like $7 to $8 a bushel. And I got to be honest, you know, at $8, there was as much in me thought corn could go to 12 as it could go to anything else. I mean, it was just one of those, sure, whatever you say could happen, very possible it's going to happen. And, you know, if we kind of remember what happened afterward was that. Now, what I would say from a risk management approach, as you're looking at this, viewing this, talking about where do I think new crop corn prices are going to go, could you rule any of these phases out? Could you rule phase 1? We're in that. Could you rule out this if we have a planting delay this year, followed by a collapse if we get an okay crop, and all of a sudden, you know, a lot of the S&Ds kind of track themselves? Earlier parts to this message, we talked about how demand has been starting to show signs of concern. Feed demand isn't there internationally. China's talking about possibly looking at price supports for growers. I mean, these are ways this high prices gets cured by high prices. So I can't rule out any of this stuff. I don't think we're going back to $3, but I think, you know, to see a rollover post June seems to fit. I'm going to skip this chart for a sec. We'll come back to that. But I do want to hit on this. Why do I think that? You know, what this chart shows is a seasonality of corn since 2005. Why do I start at 2005? That's to me when we saw the shift in ag. You know, before 2005 was pre-ethanol. 2005 forward was kind of a new market. 2005 forward shows, if you think about what has happened since 2005, you've got a little bit of everything. You've got several years of severe drought. You've had weather issues. You had a massive planting problem. You've had trade wars. You've had China buying. You've had ethanol. Everything about it. You know, there's been everything. But this is what that seasonality looks like. Generally speaking, from Jan through March, you're going to have kind of sideways higher market action. Then you start to get in the growing season, and April, May, June is when you start to have a little bit of that peak, that crescendo. Why? Why do we put our peaks in June in corn? Normally, that's when there's the most uncertainty in the market. Corn market usually values uncertainty as higher. We're normally going to go higher in an uncertain time frame. There's one time I can think we went lower on uncertainty, and that was last year, right in here, when demand and COVID was uncertain. We went lower. We were trying to figure out what's the worst case scenario, not the other side of the spectrum. So I think that's interesting. Quick aside, last year's seasonality was almost the mirror image of what a normal seasonal approach is. Making your lows in that June timeframe and your highs at harvest is totally counter seasonal. So this is the time when weather, we're just kind of wrapping up planting. We're looking ahead into the growing season. You get a look at that weather for July. If it looks not extreme dry, extreme heat, the market starts to take off weather premium. An important thing to note about weather premium is also that sometimes you can go lower even if you did actually realize some bad weather. But the bad weather becomes unknown. And when it becomes unknown, the market starts to put that into a less volatile situation. So could this seasonal pattern play out this year? I think it's a good chance that this is what plays out this year. Marketing into the current prices is obviously an incredibly smart decision today. Finishing your next unit of sales for new crop corn, if we can see that June seasonality peak, once you get into that 4th of July is kind of when you have to have your marketing plan solidified. In fact, I shouldn't even say solidified. That's when you should be kind of finishing what you for sure want to have sold, because the post 4th of July timeframe is kind of a slippery slope. So, yeah, I kind of want to finish that 2008 thought. So yeah, I think that this is going to be kind of mimicking that general trend this year. That's kind of where I feel things will go. This chart shows, July soybeans. And what I wanted to show here is I'm pretty friendly beans, not only old crop, but new crop. In case you didn't get that from my presentation, I think there's a lot of work left to do. We still are selling some beans on export. We still got a lot of crush left. We don't have a lot of bean supplies left. This is other tight years of bean futures though. What happens is that I talked about how South America starts to become the focal point for the world market. The US is really just going to kind of go into our own domestic market. If we are a domestic story, sometimes futures are not necessarily the only tool that's at work to make sure you have an adequate supply into the new crop. And that's what this shows. It shows kind of a range historically of about 1325 to 1525 on old crop beans into that July timeframe. And I think that that's probably accurate. I think this is where we're going to see some old crop bean futures trade this year. This year is extremely tight US wise, but it's not globally. We just got the largest South American crop ever is about to be combined, and that's hitting the marketplace. So it may be up to the US markets to deal with that. How do we deal with that? Could be a basis move, could be some spreads as well. But this is a kind of an outlook of range potential for beans. So I'm not necessarily an $18 guy, and I'm definitely not in a $50 bean guy. But anyway, so kind of have that as my targets on old crop. I'm gonna really quick go through this. This is the managed money piece. I kind of got a little bit discombobulated with my flow here on this section, but I want to come back to this piece. We talked about the money flow. This is money flow pertaining to commodities. Now, this is the managed money crowd up in the top two charts, the soybeans and corn. And what it shows is the long in the market in the light blue, the short in the market in the dark blue, and then prices are overlaid on the orange. Now, I want you to think about managed money. Managed money are speculators. Their mission in the market is to just make money off of buying low, selling high, and vice versa. So they just want to make directional moves. Look at how correlated their position is with price. They are price drivers. Now, who's on the other side of the speculator? Almost always the primary person on the other side of that speculator is the commercial, the producer, the merchant. Now, what this chart shows is the blue line shows the commercial short and the light blue line shows the commercial long. So the long would be made up of like end users, things like that, people like that. The short, who's the short? I hope they're watching this because they're the grain elevators, they're the farmers. The commercial gets short as the farmer sells grain. So as you can see what's going on in this last move throughout this fall, funds were buying, prices were going higher, farmers were selling like they have never sold before. This was the largest stretch of farmer movement we've seen in history. That meshes with everything I track data-wise. And that's always going to be how this market works. The funds are usually going to be the price drivers of higher moves. The farmer's going to sell into it. The problem is on times when the funds are sellers, you can see the farmer doesn't sell anything. And in that situation, that's when basis starts to do a lot of the heavy lifting. But I wanted to illustrate this because there's no short in this market. We've got a record long position essentially in the corn market. Now, money flow has stalled. We've not seen a lot of new money come into the corn market in the last few weeks. In beans, believe it or not, the peak of the speculative money in the soybean market took place in October of this year. Beans are kind of feeling like they're wanting to get a little bit of a second life, but corn's kind of languishing. We're not seeing, on the heels of that neutral crop report in March, there's just not a whole lot of money flow coming to the marketplace. And so we're kind of looking for that second phase that I talked about in that 2008 analog to materialize to kind of drive this market further. So we'll finish up lastly with the soybean seasonal, which is very similar to the corn seasonal, with one major exception is that a lot of times that soybean price will continue to hold into July. And that makes sense. I think most people would view July as the make or break month for corn and August for make or break month for soybeans. So in this case, in the case of corn placing as high as in June, it gets a look at the July weather before breaking. In the case of beans, it gets a look at the August weather before breaking. But in both cases, you had very counter seasonal approaches, almost mirror images last year of what normal looks like. So with that, I am finished with the entire slide deck, and I'm happy to answer any questions that might still be lingering out there on any of the 4 portions we covered.
Hey, Matt, I got a question. So the growers, in our trade territory, we're in call it a moderate drought area, right? I know that's kind of top of mind for a lot of guys as far as trying to make new crop marketing decisions. Looking at possible opportunities from a seasonality standpoint. What are your recommendations for a grower that has concerns about production and, whether this drought condition does carry it into the summer months or not, but still capture these, nice prices or appealing prices? I guess, what approach would you recommend?
It can be challenging. That's something that I think is a challenging situation. The best advice I'd have would be, looking at some put options or something like that. And I say that because a put's one of the few tools that doesn't bind you into something in terms of a commitment. It can still give you some flexibility if that ended up being an unplanted situation, or if you're just looking for yield concerns that might develop, it still gives you plenty of upside potential throughout the summer growing season. But it's hard because the puts aren't really cheap right now. They're not giving those away. And so you may have to look at a put spread or something like that might make that a little bit more palatable. My best recommendation, and I know I don't necessarily want to just turn it back to you guys, but I do think this is a one-on-one discussion, because I think you're going to find a lot of growers are going to have different risk reward profiles, and to give a blanket comment is a challenge. But I do think these prices are too good to just sit idle if you're planning on going any direction. I think that's still have to market into it, but maybe you're just less aggressive. You're not looking for features with double ups. You're not looking for things like that this year, a little bit more so than what we would be normally. Jim, that's a tough question. I don't want to punt for an answer, but I kind of feel like I did, and I know that's a challenging question.
I'll take the opportunity here to remind our growers that are watching that get a hold of Jim, get a hold of Doug. They've got the FCA Market Navigator tool that they can use to help you build a marketing program that is going to be based around your costs of production with a lot of detail, as much detail as you want to throw into it. Let's put it that way. So that'd be one way to try to, like Jim said, take advantage of these appealing prices that the market has gone to for this 2021 crop. All right, well, if there aren't any other questions from our small group here, Matt, I want to thank you again for taking your time and sharing with us your analysis on where the markets have been, where we think maybe they could potentially be going, and all of the things that are going into the why for each of those scenarios. To you, our FCA grain patrons, we want to say thank you for your past business, and we hope we're able to continue to bring you marketing solutions for the coming year's harvest and beyond. In conclusion, I'd like to put a quick plug in and remind you, the grower, that we have a new bushel, FCA bushel powered app, smartphone app or device for your smartphone or devices. Very powerful app in terms of being able to see your scale tickets, settlements, contracts that are open. It's a good tool. Give us a ring if you haven't downloaded that yet. Take a look at that. We'd really like to see additional usage out of that app. It's coming shortly. You, the producer, will be able to, through the app, enter and manage your own open offers for sales of corn and soybeans to First Co-op. So it's an exciting new tool that we're glad to provide, and hope that you're able to make use of it. I guess we'll wrap this up. This is the end of the fourth segment of our 2021 FCA Grain Outlook meeting. We look forward to seeing you, our producers, through the marketing year. We hope that this 2021 year turns out to be a great weather year, a great crop year, and a better year in terms of get past this pandemic and just kind of return to normal. I would like also, as we close here, I'm going to have each of the team members here join in real quick and just reintroduce yourselves for everyone, and then we'll wrap things up.
I'm Doug Stout up at Primgar, Iowa.
I'm Megan Plendel. I'm assistant merchandiser in the Cherokee office.
I'm Jim Porter, grain originator, live in Cushing. I work out of the Cherokee office.
All right, thanks everyone. Again, we appreciate you, our producer, and thank you for your past business. Look forward to working with you going forward. We'll conclude now and look for more of these video recorded segments. This is something that we feel we'll probably be able to make use of this as a tool to continue to try to bring market intel and information to you, our customer, as we go forward. Thanks again, and we hope to see you soon.